Everybody knows the Magnificent Seven has been red hot lately. Are you thinking about putting more money in and buying more into those stocks? If so, think again. I'm going to show you how loading up on the Magnificent Seven right now could absolutely derail your retirement plan. My name is Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, and I'm here to help you retire in style. All right, let's dive in. So Magnificent Seven has been absolutely crushing it lately, off the charts. And you take a look at companies like Apple and Microsoft and Alphabet, Amazon, Nvidia, Meta, Tesla. I mean, who wouldn't want to own great companies like that? In 2023, they were up a combined over 70% returns. Who wouldn't want 70% returns? And if you're like me, your neighbors are talking about it, your friends, your family's talking about it, everybody's talking about how much money they're making hand over fist in the Magnificent Seven. Meanwhile, in 2023, the S&P 500 returned a measly 26.3%. So you're going, oh, if I put all my money into 7 stocks, I would have done north of 70. I don't know about you, but I would take 26.3% all day long. And the problem with loading up on the Magnificent Seven right now is that what comes up eventually must come down. All these things ebb and flow. They get hot and then they go cold. And let me show you the risk of loading up on the Magnificent Seven right now. So over the last 10 years, take a look. I'm looking at an index right now, the Russell 1000 Growth Index. So the Russell 1000 Growth Index is a measure of the 1,000 largest growth-oriented companies in the US. The Magnificent Seven live right in this space. Let's look at the last 5 years of returns. This index is up 17.83% per year. Now, the long-term return on this index is right around 10%. So that's outperformance of its long-term average by close to 8% per year. In other words, it's been red hot. And how about the last 10 years? The Russell 1000 Growth Index is up 15.27% per year for a decade. That's outperformance of 5.25% per year, folks. I mean, it's almost 50% outperformance over the last 10 years. It's been red hot. Let me put it to you another way. The time that you should have bought into this index in the Magnificent Seven was 10 years ago. But I don't know about you, but my crystal ball broke years ago. And the truth is, nobody has a crystal ball that works. If they did, they wouldn't be working. They'd be on a beach in the Bahamas right now. So don't let anybody fool you. Not even Jim Cramer, not even Warren Buffett. They don't have crystal balls, okay? That's just a farce. All right. I want to show you, this is on average, when companies like the Magnificent Seven, which now represent a bulk of the S&P 500, not the majority, but a large percentage of the S&P 500. They've just become huge companies, okay? Let's take a look at the performance in the 3, 5, and 10 years leading up to when these companies become really, really large. What you're looking at here is the last 3 years, so 26.3% per year for 3 years. For 5 years, 20% per year for 5 years, and for the last decade, 11.3% per year for 10 years. So really, really good performance numbers in the 3, 5, and 10 years leading up to when these companies become the behemoths of the market. But a funny thing happens. Once the companies get to be the dominators in terms of market share, the next 3, 5, and 10 years are not so good. Let me show you what I mean. On average, 3-year performance after becoming the market dominator, less than 1% per year. And 5-year return is actually negative. Same with the 10-year return, both negative. Again, highlighting the importance that the time to buy these companies is to catch them on the rise. But the reality is, no one can predict the future. It's too hard. You're better off owning the index, and you don't have to worry about picking and choosing individual stocks because it's a very difficult thing to do accurately on the go forward. But by owning the entire index, you benefit when a select few companies like this go off the charts, the way the Magnificent Seven has in the last 5 and 10 years. So if you're sitting there and you're a little skeptical and you're thinking, the Magnificent Seven, those companies are never going to not dominate. In other words, the Magnificent Seven, they're going to dominate forever. You might be thinking that today, and you'd be wrong. Let's take a trip down memory lane right here. IBM, now we're back to 1980, 1985, 1990. So for 10 years, IBM had its glory run. And nobody ever thought that IBM wouldn't be the market dominator in 10, 20, and 30 years. But if you look today, IBM is nowhere to be found, at least not in the top 10 as far as market size goes. Another great example, let's take a look at Coca-Cola. Back in the 90s, one of Warren Buffett's darlings. It's not there today. The one I really like to look at is General Electric. Back in the 90s, 2000, 2005, much like the Magnificent Seven today, people thought that GE would be the dominator forever. Well, let's take a look at what's happened to General Electric since it peaked there in the 2005 to 2008 time period. Since 2008, General Electric has lost 50% of its value. It's been cut in half in a roughly 15-year time period. That's a lot of money. And in the same time period, the S&P 500 has quintupled. That's a 400% for the S&P 500 in the time period that General Electric has been cut in half. Again, this goes back to my point earlier. It's a fool's errand to try to pick individual stocks and think that somehow you're going to outperform the index. Why not just own the entire index and let the companies, as they're having their day in the sun, let them carry the day, and you get to benefit without all the pressure and stress of having to select the individual companies accurately? Because the reality is, nobody can do this, at least not consistently over long periods of time. So if you're starting to understand that, okay, we shouldn't own individual stocks because there's too much risk in owning individual stocks, then maybe we should just put all of our money in the S&P 500 because it's had a phenomenal 10-year return. The last 10 years have been fantastic for the S&P 500. And if you're thinking that you should put all your money in the S&P 500, I'm going to show you why that's crazy. You would never want to put all of your money in the S&P 500. It's a fool's errand. In fact, you would never want to put all of your money into any one asset class. It's too risky. Let me show you what I mean. This is the time period from 2000 to 2009 when the S&P 500 lost 1% per year for an entire decade. It lost money for 10 straight years. And in that same time period, you had a whole bunch of different asset classes that did fantastic. You had US small companies, you had real estate, international value, you had international small cap, you had emerging markets, you had even bonds outperformed the S&P 500 for 10 years. This was an awful decade, often known as the lost decade. When we have lost decades like we had from 2000 to 2009, it can really cause havoc and literally blow up a well-prepared retirement plan. Let me show you what I mean. So this is a similar time period here. This is 1999 through 2013. So we have a 14-year time period here, and the S&P 500 compounded at 4.68% per year. That's less than half of its long-term average, which today still is close to 10% per year. So if you're like the people who loaded up on the S&P in the late 90s, it had a really similar run in the 90s to the time period that it's just had. The S&P was lights out in the 90s. It's been lights out in the last 10 years. And then in between those decades, it lost 1% per year for a decade. The folks that loaded up on the S&P in 1999 and retired, and then took out roughly 5% per year every year in retirement, guess what happened to those folks? They all went back to work in about 2016 because the S&P 500 had a horrific 14-year run. It literally almost went flat for 14 years. And so again, highlighting why you would never want to put all of your eggs into that basket or any one of these baskets. And if you're sitting there and you're a little skeptical and you don't think that that could ever happen again, think twice, because it wasn't the first time that it happened. This is a time period right here. This is 1928 to 1949. That's 21 years where the S&P 500 was underwater. 21 years. And as if that wasn't bad enough, the other time period was 1966 to 1982, where it literally went flat and it underperformed cash, bonds, and inflation in that time period. So again, we're highlighting the fact that you do not want to put all of your eggs into the S&P 500 or any one of these asset classes. So what you should do is build a portfolio of globally diversified stocks, not individual stocks, but ETFs, which stands for exchange traded funds. They're low cost. They trade for free at most major custodians like Schwab and Fidelity, and they give you globally diversified exposure to thousands of companies in a really low cost manner. It's a fantastic way to build a portfolio, and it's really the evolution of investing. This is the modern way to invest, folks. We're not going to our stockbroker down the street for some stock tips or some hot money and let's buy a company on sale and quintuple our money in a year. That's like the movie Wall Street. We all remember Gordon Gekko. Greed is good. Money never sleeps. Yeah, that's not the way to invest. This, what I'm showing you here, this is the modern way to invest using ETFs, okay? So let's dive in and take a look. So during the 70s, this is when a globally diversified basket of securities, right here in the green, outperformed the S&P 500 pretty handily. During the late 70s into the early 80s, it flipped. S&P 500 outperformed. And during the late 80s, global outperformed S&P. During the 90 dot-com bubble, the S&P 500 absolutely crushed it. And then it flipped again from 2000 to 07, a globally diversified portfolio outperformed the S&P 500. And you can see pretty consistently that things tend to ebb and flow. Now, as of 2022, globally diversified has actually been outperforming the S&P 500. Will that trend continue? We don't know. We can only use history as our guide, but one would conclude that there's good probability that it might. There's also a great probability that if you like this video and you subscribe to this channel, you're going to get the information you need to be a successful investor and retire in style. So putting it all together, if we were to take a big step back and look at the last 50 years of data, okay, what you'd find is that investing in a globally diversified basket of securities has significantly outperformed investing in the S&P 500. So just because the S&P 500 has been red hot for the last 10 years doesn't mean that it's outperformed a globally diversified portfolio over the last 50 years, because it has not. So what if you're concerned about investing internationally? Okay, I would understand why you might be concerned, because over the last 10 years, the S&P 500 has been red hot and the international investments have not done as well. Now they've been in positive territory, but just not to the degree that the S&P 500 has outperformed its long-term average over the last 10 years. Now, what is the culprit for this international underperformance? It's not what you think. If we were to look at the performance of the international investments in their own currency, they've actually done fantastic. The challenge is we have a US dollar that's done nothing but gain in strength, get more expensive over the last 10 years. So as we're bringing foreign profits back home to a strengthening US dollar, we're bringing less of those foreign profits home. So on paper, it has the appearance that the international investments have not performed as well, when in fact they've actually performed fantastic. It's just that our US dollar has gotten really, really strong in the last 10 years. Let's take a look at the 10-year performance of the international investments right here in blue. It's been fantastic. But when we look at the performance in US dollars, it's been okay. So A 9% return turns into a 5% return, and that's all due to the currency trade. You can see that right here, that the strengthening US dollar has really eaten into the profits of the international investments. And like anything, will that trend go on forever? Absolutely not. In fact, I remember in the 2000s when the real fear and concern was the US dollar was going to lose all of its purchasing power, and it was not going to be the world's reserve currency any longer, and it was going to get weaker and weaker and eventually go away. And what's happened in the last 10 to 15 years is just the opposite. The US dollar has gotten really strong, which is what's resulted in this phenomenon of weaker performance on the international investments. Again, the international companies have been doing just fine. It's the strong US dollar. But trees don't grow to the sky, and this won't continue forever. The other thing that I like about the international stocks, so if you're concerned that US stocks have high valuations, you'd be right. The US stocks still have fairly high valuations. We've just come back to a recent market high. And so in comparison, the international investments are on sale from a valuation standpoint. So if you can buy a stream of cash flows for less money, why wouldn't you? The other thing that I like about the international investments right now is that in the United States, in particular in the S&P 500, all of the performance, or a majority of the performance, is concentrated in the largest 15 companies. So we just talked about the Magnificent Seven, and if you were to look at the biggest 15 companies in the index, that's driving most of the performance of the S&P 500. In other words, it's more concentrated and it's less robust. Those are not signs for market health and market strength. When we look at the international investments, so you see that the largest 15 companies are responsible for far less of the performance internationally. In other words, the performance is more broad, more robust, which is a sign of a healthier market. Another reason to consider investing internationally at this time. Now, I'm not saying put all of your money in the international index as well. Quite the contrary. Let's take a look at this. You'll get a really clear idea. So this is each of the asset classes that I'm talking about here on this video. And this column here shows you annualized performance over the last 10 years. And you could see that US large companies is leading the pack, compounding at roughly 12% per year over the last decade. You could see US large value companies, second place right there. US small companies is in third place. And I want to draw your attention to this little white box here. And this little white box is an example of an investment portfolio that's globally diversified with roughly 60% of the money in stocks, 40% in bonds, and of the stocks, about 60% are in the US in both big and small companies, but the other 40% of the stocks are in international investments, both big and small. This is an example of the globally diversified portfolio I'm talking about, and it includes bonds. And what you'll notice is, as I just mentioned, it's not in first place, nor is it in last place. It's almost right there in the middle of everything. And if we take a look at the last 10 years, let's go back to 2014 and let's follow along. Take a look at this as I draw it out. The white box, never once in first place, never once in last place, always kind of staying somewhere right there in the middle. And that's the kind of experience that you want as a retiree. You don't want your highs to be too high or your lows to be too low. You want to just be right in the middle, consistently moving forward towards your goals. Now, am I saying that you buy a portfolio and you forget about it for 10 years? You buy, hope, and pray? Not at all. I'm saying that you need to be active in the rebalancing strategy that you take, that every year you take a look at, well, which asset class is at the top, or what are the top performing asset classes each year. You need to trim or sell just a little bit every year, and then you need to buy into the asset classes that are at the bottom. So in this manner, this is taking a disciplined approach to buying low and selling high. And this is called rebalancing. And we all know that we need to do it, but guess what? Nobody does this, or they don't do it well. If I'm talking to you right now, it's okay, you're not alone. But when I look at thousands of portfolios and I see this every day, nobody is rebalancing correctly. People are chasing after the hot stock, the hot tip, or the hot sector, and they're shunning or they're afraid of what's on sale. And we need to look at this just the opposite. Look at it like you're buying the sweater at 50% discounts to what you'd buy it normally. Go buy it cheaper. Just like we talked about with the international investments, this needs to be part of your process every year, every quarter to do it right. And if you do that, you can manage risk, you can improve outcomes, you can improve performance over time by maintaining discipline. Okay? So I know we covered a lot today. If this resonated with you, or if you have questions about anything that you saw today, please feel free to get in touch with our office and we'll sit down and we'll help you put together a plan of attack to manage your investments and help you move towards your goals and retire in style and stay comfortably retired.